Scale is the blockchain that's truly built different. Explore more at scale.space/ecosystem and follow them on X at Scale Network. Hey everyone, before we get into the show, just some quick housekeeping notes here. We're conducting an audience survey of the Forward Guidance audience, and we're just trying to gather feedback on what are some of your favorite parts of the show, what could you see improved, and what's your general vibe of things so that we can try and improve it. So the link to the survey is in the show notes. So if you could fill it out, that would really help us with improving the show for you as we move forward into the year. Thanks, everybody, and back to the show. All right, what's going on, everybody? Roundup edition for guidance, and you will notice that unfortunately our brother in arms Tyler had to miss again. Tyler's in a bit of a not transitory inflation state, but just shifting into a new gig. That's kept him pretty busy. So we're sorting out a bit of a plan there, but yeah, we'll have more updates for that. So apologies for that. We all miss Tyler dearly. We were just laughing that maybe him and David Sachs are just too important now for their podcasts and off saving the world. Maybe he's the man behind doing the crypto AI czar thing with David. That could be the answer. But yeah, we miss him dearly. We wish him well. We'll hopefully get him back on soon. But yeah, for this week it'll just be Quinn and I again. So Quinn, what's going on? How are you?
Not bad, man. It's these weeks are flying. And it feels like everything's happening. But then you look at the markets and nothing's happening. So yeah, it's fun.
Dude, I was looking at a chart of like NASDAQ and like SPY, and it's just been like the most volatile chop for like a month at least now. And I'm like, I didn't even like clue into that. Like, it's just like until you properly look at it, you're like, oh my God, like no wonder everybody's losing their minds right now.
Yeah. And then you mix the crypto, non-Bitcoin bloodbath that's been of late, and you just get a great cocktail.
Okay, before we get into things, I'll do a little plug here. We're pretty close out from DAS Summit in mid-March, coming up real quick here. Quinn and I are going to be there. It's going to be a ton of fun. We're going to have a live roundup. There's going to be some really great guests. I'll be actually doing a keynote speaking with Mohammed Al-Arian there too. So that's going to be really cool. There's going to be a sweet macro panel that I'll be hosting with Jim Bianco and Joseph Wang. So that'll be wicked. Tons of other great stuff. Hopefully we can plan a sweet side event too for the Forward Guidance listeners, meet up, drink some beers, that sort of thing. So yeah, get your ticket. There's some discount codes out there. You can use FIJO20. They'll get you 20% off. Or you could use Quinn's discount code too. Pump up his numbers as well.
Pump the numbers, drop rookie. Dude, yeah. You get 20? They only gave you a code for 10.
I know. It's so that I could just strong arm you and get the numbers up.
I don't even get anything. So use Felix's because I don't get anything. I'm just being a good Samaritan.
Yeah, I don't even get anything either. It was just, it's for the thrill of the game. So it was pretty funny last week. We recorded that pod, and it was like as these headlines are coming in about the tariff fears, and that pod went from being, aging well to aging horribly back to aging pretty well again. And it just really is a sign of the times right now where we were like, okay, tariffs are going to be real. And it's like, okay, just kidding. They're not going to be real. Oh, they are definitely going to be real now. Oh my God. And then come Monday, turns out they're back to being, now they're delayed is the answer. So yeah, that's really, maybe we could just like pick up by following up from there and what we've seen, and, maybe hear a bit about how you thought the week has went. And, were you surprised to see that at the last second, that the tariffs got delayed by 30 days and there was some sort of, agreement that came forth? Yeah. What do you think about that?
Yeah, maybe we talk about that's a good point to start. Like we obviously we're rambling on here about, the market friendly nature. It's one where you just have to consume all the information and try to make your best determination of if it's, because Trump has this style, right? That's bluster, just kind of speak in exaggerated terms and promise the world. And a lot of times it's negotiating tactics. Sometimes there's meaning behind it. Sometimes it's just bluster. And then on top of that, you have like the media reporting things that may or may not be happening, and 90% fake news. So it's a tough environment, especially if you're like trying to trade headlines without sturdy, high conviction views. In that case, like when markets are at range highs here, like I'm pretty cautious and looking to like hedge my longs. That was the case last week, right? Like Bitcoin was potentially making a push, and and then you had something like that would easily throw people off risk appetite, risk sentiment off. Like, do you want to stick your neck out there over a long weekend type of thing? And I think that's just what it exposed on the crypto front was not that the tariffs affect crypto directly. There's all these takes about how tariffs are so bullish Bitcoin and things. It's like tariffs,
That
there's
was
no,
tough.
like, they're nothing to Bitcoin. Like, it's just, they're so, but what it showed was just the extreme over positioning, right? Everyone was still, because we didn't get to sell the news from the inauguration and all these things, people were like lazily holding on to way too much exposure. And I mean, we even saw it with the Sachs press conference this week. It was like, what are people expecting? Like him to wave a magic wand and $2 billion of Bitcoin to appear on the government's balance sheet? Like, this is ludicrous. Like, so it was just, there was a sense of complacency, and if anything, very easily could knock it off. And that's kind of what I felt and why I had de-risked. But yeah, and we're, keep in mind, from last March through July, Bitcoin didn't make new highs and was kept bouncing and hitting range lows and coming, and then range lows again, or new range lows. And stocks peaked in July. So stocks need way less liquidity. They have earnings growth. They have strong economy behind them to keep afloat and moving higher than Bitcoin. So, in these periods where everything's going up and everybody's geniuses, it's easy to forget that. And I think, it's just, yeah, it's creating this like very emotional market environment.
It's tough when expectations start to not match up with the reality becomes. And this is what we talked about in the lead up to the inauguration and around like the strategic Bitcoin reserve. And it's like, okay, even though we know we're going to get bullish headlines, and this is something that, just takes time for people to understand, like how markets react to expectations versus reality, is like leading into it. There was a lot of expectation of, okay, day one executive order. Will it be, just a stockpile where we earmark the existing assets and say we're going to hold those, or are we going to start buying up Bitcoin as well? We got neither of those. We got pretty much nothing. And then we've got this minor executive order where they came in and said, okay, we're going to evaluate, strategic stockpile. Now it's evaluate the strategic Bitcoin reserve. So in isolation, these headlines are very bullish, right? We've got a ton of bullish headlines over the last 2 weeks about, positive regulatory dynamics, but we're not seeing, the same run up in prices that you might expect during these times. And that can be really confusing for people that aren't used to seeing run ups into event driven catalysts, where it's like, okay, we need to think about what was baked into price into the lead up of that, which is that we were expecting a full on Bitcoin reserve. So just by getting marginally less, that hits price and it hits expectations and it hits emotions. And so you have to recalibrate that outwards. And, we're seeing that process now. We've seen that process with alts who have just been in an absolute bloodbath. And that's because I think there's a lot of complacency and denial of what was going on, where it's going to take longer than most expect for the truly substantive positive outcomes to occur. And then at the same time, you have expectations that are way dislocated from that. So that needs to be recalibrated. And we've seen that recalibration now. So it feels like we're nearing that end. It's impressive how strong, like relatively, Bitcoin's held up, that it hasn't broken down from this range that it's been in. I think that's a good thing overall. But yeah, the same can't be said for alts.
Yeah, I think I would just, anybody who's in crypto listening to this and evaluating their portfolio, I would take a step back and look at the last 2 years, which I would characterize as two very bull market-esque years. And Bitcoin returned 155 in 23 and 121% in 24. And ETH did 91 in 23 and 46% in 24. So like, and given where we're at in valuations and retail participation in the stock market and all risk assets broadly, like if you're sitting here expecting alt season, like, I'm sorry, but it's just not grounded in reality. And, I think people who are trying to trade this asset class solely based on cycle theory are really going to struggle. We're seeing some alts make new lows or retrace their full post 2023 moves, and man, that's a tough environment if that's what you're chasing. And I just don't see a reason. Like, I have a pretty mixed to negative liquidity outlook for the next few months, potentially even most of Q2, and I just don't see that trend stopping. Like, Bitcoin has very clear tailwinds, and I'm having a hard time seeing it on the rest of the complex. Like, everybody kind of waiting complacently for, like, quote unquote alts. No one will tell you what they should be worth or what they should be valued at. It's just because that's what they've done in the past in one other cycle. Like, no one can give me an answer what they should be worth. Nobody.
Scale is the blockchain that's truly built different. Forget gas fees and waiting. Scale offers a seamless Web3 experience with fast, fee-free transactions. Whether it's gaming, AI, or next-gen dApps, Scale is here to power your future. Explore more at skale.space/ecosystem and follow them on X at Scale Network. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Let's start with that liquidity outlook, because I want to hone in on, first off, with the dollar and what your thoughts are there. Because when you look at, I'm a big believer that this year, like, currencies are going to be the key thing to look at, just because of all the tariff dynamics. And okay, so you look at the Dixie right now and where it's at. It's come off the recent highs a little bit, and a lot of that has been due to the slightly less concern of tariffs, as we've seen over this past week. But regardless, a lot of that move has also just become of the sheer economic strength of the U.S. compared to every other country. Like, just for example, today, Canada's been in the news more probably than I would like this week for a variety of reasons. But we got the PMI from Canada today, and it was like 47, as opposed to the expected was like 52. So, like, just substantial economic weakness, right? Compared to the US, where we saw an ISM this week of over 50. So the first, expansion print in 2 years. And so I think a lot of the dollar strength is warranted. And even though I don't really see much higher for the Dixie, I don't see much lower either. So it sort of feels like chopped slightly down if we get more positive news headlines on tariffs. But I see a lot of people holding on to this hope that we're just going to flush right back down to like 100 on the Dixie, and that's going to spark the next leg up in risk assets. But when I think about the economic fundamentals and how that gets reflected in rate differentials, I don't really see it. Do you?
No, I would say the red flag, from my vantage point, is how drastic of a move in rates we've had without as big of a move down in the dollar. And I think that's a kind of signal as to either, just like you said, the US's growth picture being that much better than the rest of the world, which in some cases is true. Like Europe, Canada, things just keep disappointing to the downside, and those central banks have to get more dovish. And you have a little divergence between then the US and Japan trying to get slightly incrementally more hawkish. And on a liquidity front, I think everybody just needs more Fed rate cuts. And those are not coming in March, in my opinion. And I think the market's expecting either May or June. I think that's directionally accurate, but I don't think that it's all roses if it's May or June when the next cut comes. So, it's not that you have to be like uber bear, but it's definitely not 100 basis points in 4 months type of liquidity environment. And I'm pretty neutral to pessimistic, to be honest, on it. Like, it's tough to like create a case why the dollar's going to preemptively, before economic weakness that gets Fed to move, why it's just going to keep go
No.
straight down.
Yeah. I mean, and then you look at the other like liquidity, valves that you could pull, and yeah, reverse repos sub $100 billion. Obviously, that's being pretty closely tied to the trajectory of quantitative tightening and the timeline there. Seems like, roughly speaking, it'll be about June until that runs its course and starts to end. Originally, most money market pros were thinking like conks were thinking like spring, but yeah, now it's looking more like June ish. So you have that going on. The sort of last holding factor of hope for liquidity was this whole TGA drawdown thing and the debt ceiling dynamic, which I don't know. We don't talk about that much, but it grabs a certain hold of some like parts of the macro world, and I think a little bit too much so than what's warranted. But like, the idea is that, okay, we've reached this debt ceiling situation that causes the trigger of the extraordinary measures, which gets run down, and then once that's completed, the liquidity that they can hold aside from the extraordinary measures, then the TGA starts to get drawn down, and that's what $700 billion of liquidity that could go into the system. Obviously, at the tail end of that is once the debt ceiling ends, they have to reverse it and build it all up again with bill issuance. But I don't really see that being like the golden goose that a lot of people see. Do you?
No, because it's not sustain. It's not run rate. It's a near-term liquidity buffer for sure, but it's not something you can rest your laurels on because it physically has to get reversed. So no, I don't think that's necessarily great. What I kind of think about right now is the market's like teetering, right? Like stocks are at range highs. We've had just continued dips, and it seems like momentum stalls out when we get back up here, and there's no real buyers that want to push us through. And from my perspective, the market is discounting a lot of success from Bessent and Trump, pro-business, pro-growth, fixing the Treasury, fixing the deficit, fixing the bond market issues. And the market is still just here. I was having this conversation with a friend yesterday about where we'd be at if Trump didn't win. I like today, the SLR thing is huge for bond yields. So bond yields have come down because they believe the cheaper energy policy of the Trump and Bessent administration.
Yeah. Can you explain this? I got the quote up here from Bowman. Can you unpack that a little bit? Just
yeah, basically Bowman said that. So this has always been one of the levers that they can pull to basically allow the banks to purchase more treasuries and increase demand because they can, exclude these from the ratio. So that eases pressure from the bond market because it creates a larger bid in the market. Bond prices up, yields down, and it allows the banks to be larger buyers of our treasuries. As global foreign central banks are sellers, and there's always the question who's going to buy the debt. So this is huge because under Barr and the previous administration, this probably wasn't going to happen unless there was an emergency. Yeah. And there's a number of others.
She's a front because now that vice chair supervision role is open, and she's a front runner for being that. So for her to say this, that we should make the SLR ratio exemption permanent, is very notable.
Yeah, and so the market between the Bessent stuff, between the QRA this week, is the bond market on the long end's quite satisfied, and yields have come down in a big way. So again, it's an interesting situation. I don't think the issues are. I still believe it's going to be a tight needle to thread throughout the rest of the year with all the debt ceiling and all these other things. And then on top of that, you have DOGE, which seems to be making really good momentum. By the way, it's amazing how the politicians are and the media and everybody who's getting paid by these government handouts is just up in arms. But that's good long term, but it could be a hiccup if the Fed's not cutting while unemployment is kind of going up because of government job cuts, which have been the leading provider of job growth. So it's a choppy period. So I wouldn't be surprised to see the markets kind of reflect that for even some long time longer.
Yeah, I feel like it's the tension between some of these levers that are starting to get pulled that are positive, like yeah, SLR, versus some of those other dynamics where it's like, yes, if we are going to see a decrease of the deficit, that can be negative for the growth picture. If you see more people, going that route of taking the severance as a federal employee, that'll eventually get reflected in jobs numbers. But that's not something that like the Fed will necessarily try to front run or anything by any means. And then also to your point about like the QRA this week, which was, I'd be keen to jump in on that and look a little bit because I think we might have slightly different opinions on the intention there, but overall, like this is a try to put together just the issuance forecasts for the QRA. And so the big question here was whether, you know, Scott Bessent has been hypercritical of Yellen and that administration in terms of tilting issuance towards bills during a non-crisis time and keeping coupon issuance constant and basically giving forward guidance that they will continue to do so for many quarters. So this is just looking at this coming quarter's issuance composition as well as the next quarter's estimate. That big negative bill issuance is just because of the tax season that happens during that quarter. They basically just use the tax receipts flows to cover that, so they don't need the bill issuance as much. But overall, what we learned from this is that despite Bessent's criticisms of Yellen, he's keeping things steady as it were under Yellen's mandate. So this is what's really key for me is that this top quote here is from the letter from TBAC to Secretary Treasury Secretary Bessent, and it's basically their recommendations of what they should do. So he said, in discussing issuance recommendations, the committee uniformly encouraged Treasury to consider removing or modifying the forward guidance on nominal coupon and FR on auction sizes that has been in the refunding statement for the past 4 quarters. So that was their recommendation. And as you can see in the bottom portion, which is basically the QRA announcement itself, they said Treasury anticipates maintaining nominal coupon and FR on auction sizes for at least the next several quarters. So basically decided to forego any change of that forward guidance and commit to keeping coupon size constant for the next few quarters. So yeah, I want to hear your thoughts on that. Why do you think this happened? Is Bessent just got scared once he got into the chair itself and it said, oh shit, like, we should probably keep this constant, don't want to kick up the long bond yields, or is there something more at play?
I think it's all about gradual implementation of new policy. So the number one thing that markets don't like is uncertainty. And so if he came in here and just tore everything up, people would be saying, okay, if he's willing to do that ASAP, like what else is he willing to do? And he's been on the job for like 2 weeks. So like he hasn't even been in the meetings to potentially change these. Like it would be very drastic to keep in mind, most of these is like, this is the Treasury, Fed, and most of the TBAC is external members. It's like bank, people that work in the private sector. So for him to come in and
I was just going to say, and also like, it's not actually Bessent who runs that meeting. Like I saw it's like Brian Smith, who's just like, I had to look into him a bit more, and he's the acting chair of this right now. And he's just like a longtime Treasury worker. Like I would call him not very political on either side of things. So I do think there's merit to the idea that this is just, he only got confirmed a week and a half ago or whatever it was. There's not enough time to really start to shake things up. But in the same vein, there was actually, Bessent was on like a Bloomberg interview today. I don't know if you caught it. And he sort of emphasized this idea of keeping it constant for the next few quarters. So I can kind of see it go both ways.
My take is that from a strategic perspective, if you're going to phase out that policy that he once criticized, then you would first start by introducing that into the minutes, which the talk of what they did on your slide of saying, we discussed this, the committee encouraged Treasury to consider removing or modifying the forward guidance, which, by the way, why did the committee all of a sudden encourage them
decide to take it off?
Guidance when
That's fair.
Yeah. So what? Like, it's the same committee, or so drop the language now because like Yellen's out. Like, come on. So if I'm him, I'm saying, okay, what are we going to do? We're going to first talk about it. So they put it in the minutes. We're not going to change it. And then the next step is to remove it. And you're going to work quarter over quarter to the place you want to get to. On top of that, Q2 calendar, Q3 government fiscal year, uh, is a huge net negative bills issuance because of the redemptions and the tax receipts and all the nitty gritty. So it wouldn't even make sense to create an even larger a negative bills quarter. And it would make sense to kind of, yeah, there's a lot of mechanical things we don't need to get into there, but implementation wise, there's also a lot of moving pieces with the budget deficit. And I think they firmly believe at the pace Elon's moving that they're actually going to make real meaningful changes to the deficit. And if that's the case, hopefully you just bring the total need down and you don't have to increase coupons, but by bringing the need down, you keep coupons the same, but total need comes down. So then bills naturally is the thing that comes down. So I think people are fading. I think people are fading hard, overly, maybe misguidedly, the impact that DOGE might actually.
That's an interesting point. That it's it's not maybe it's not necessarily the fact that we need to increase coupon issuance. It's just lowering.
We need to bring down total.
If you just bring on the total deficit, that lowers. Yeah, that's fair. I mean, it aligns with what they're talking about. Like this, there's been a lot of talk this week about like. Bessent was on a Fox Business interview, and he's talking about how Trump's not focused on the Fed funds rate. He's taking a different, and it's probably them together talking about this, and Bessent explaining like the better approach here is to work on the economic fundamentals that lower the long bond rate instead of trying to force the Fed to cut Fed funds, because if you do that, the 10-year is just going to rise in its face. So I mean that makes sense. What do you think about this idea of trying to target lower the long bond rate? Because if they're trying to get like high real GDP growth, that's going to get reflected on a higher long bond yield, right?
Yes.
Like, what do you think this achieves for them to have a lower 10-year bond yield?
Well, I think, okay, so if you take a step back and just forget everything that they've said, and you just tune it all out, and you just look at the market action this week, you had the dollar mixed, but against the yen is up. You have oil down and you have bond yields down. The last two, all those pretty big moves for 1 week. Those are growth. Like, just if you know nothing else, those are growth scare moves. Like that's just flat out, especially together. So when I'm trying to, you kind of want to separate what the market is saying to you, and then like, there's all the qualitative and like news flow and information, but it's important to sometimes try to be unbiased, untainted by headlines, because these headlines and everybody, you're always trying to ascribe a specific reason, but sometimes you find out 2 or 3 months later, oh, actually that's why it wasn't actually why everyone said it happened is what happened. And so for me, I'm sitting here looking and I'm like, is there a growthier liquidity problem that the market is trying to say? Because, okay, we know Elon's cutting heads at government. Government's been by far the number one driver of job growth. We know that growth globally in Europe and Canada is in the gutter. We know Japan is like inflation problem and their economy is okay, but like it's a big inflation problem. They need to hike, and they're letting their bond yields kind of go up, and the yen's strengthening, which isn't good for liquidity generally. And then you have these comments of Trump saying, oh, the Fed should have held rates steady, which again, not good for liquidity or growth. And then I look at those moves and I'm saying, well, flight to safety in the yen, because there's tightening, flight to safety in the long bond, and it's flattening, it's bull flattening, meaning front end rates are come down a little, but not that much, because they're not cutting anytime like in the next meeting, but the long bond is pricing in lower growth. And oil is saying either one, they really believe that the drill baby drill energy policy and Trump's ability to affect geopolitical change, or there's a demand something. So I think that there's some like red herrings, and you just got to be you got to watch the price action and stuff. And to me, it's they're kind of saying, yeah, like we probably shouldn't be running it hot by bringing the long bond down. The only way to do that is by bringing down pretty much growth expectations. And I mean, I wouldn't expect Trump and Bessent to come out and say, yeah, we got to kneecap growth for a bit to fix things, which is what has to happen. If you're going to cut the number one job provider that's provided all the job growth in the last 2 years under this inflated deficit driven economy, you're going to have a little growth hiccup. And I don't think they're going to come out and say, hey, we're trying to put 1 million people out of jobs, but they kind of are. And then what are the long bond yields doing? They're going down. So yeah, maybe some pain they're willing to take on prior to versus just Trump's like cut rates, zero taxes. Like it seems like like something's gotten through to him. Like Bessent, like he's listening to these people, man. They're like, it's giving me confidence. That's why I don't think the stock market is like, because is just kind of, I think it's treading water because it's like, man, the stock market can look through if you have near term issues, but a longer term, healthier economy. So it's interesting.
Scale is shaking up the blockchain game. With a gas-free, invisible experience, it's the perfect solution for developers and users alike. Forget unpredictable fees. Scale's innovative model ensures smooth, cost-free transactions, saving users over $9 billion so far. With over 46 million active wallets, Scale is proving itself as the go-to blockchain for gaming, AI, and more. Explore the Scale ecosystem at skale.space/ecosystem and follow their journey on X at Scale Network. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Yeah, the red herring thing is big for me because I keep going back and forth between like, yeah, okay, when I look at some sectors, it's like growth slowdown maybe, and then others, it's like, or are we actually in the start of a new business cycle? I'll show a couple examples. Like we got the JOLTS report this week, and the construction sector, the housing sector, is kind of a mess. Like this is a great chart just showing job openings for construction and manufacturing, and then X that, and like the hyper like business cycle sensitive components are just falling off a cliff here. So you have that going on, and you see just how much of a mess the housing sector is in general. And you're like, okay, well, that's the Warren Pies thesis that like I interviewed him a few weeks ago, which is that the growth slowdown will come from the construction sector and the housing sector. And I'm like, I can see it here. But then you look at like PMIs here, and like I said earlier in the show, we saw the first above 50 print on the manufacturing PMI in 2 years, which for those that aren't too close to these like diffusion indexes, above 50, that's an expansion of the manufacturing sector. And we've just been in the doldrums, like in a soft recession almost for the past couple of years. But perhaps that's tariff stockpiling. Maybe that's front running. I'm curious your thoughts, because we've seen, like new orders have exploded higher recently, and now we're starting to see it into these other diffusion indexes. So I'm trying to figure out, is this a structural shift in the economy where the manufacturing sector is coming out of this small recession that it's been, or is it just concerns for tariffs? So we got to stockpile while we can.
Everything's so nuanced, and that's what makes calls and talking about this, because it's all everything's a if this then that, or like there's it's like very mixed responses. But how I would explain this dichotomy is everything post-COVID world has been two speed because of the way that the Fed has enacted monetary policy and done it through these Treasury coordination and balance sheet buffers to keep front end rates higher. And what we talked about a long time on the show is that abnormally high front end rates, which are still too high, have hurt small businesses, manufacturing sector, small, medium sized, regional banks, etc., and helped the large caps, cash rich companies, Mag 7. And so if you think about that, it's like now that the yield curve finally became positive sloped and uninverted, steepened, banks regional banks in particular now are profitable, they can actually increase lending. So you're seeing a big growth in credit creation, lending appetite, all these, usually associated with a new credit cycle and manufacturing cycle pick up. On top of that, you've seen small business optimism. Everybody's gung ho for Trump. Businesses are investing again, hiring again, et cetera. That's all private sector. And that's all like a big foot has just gotten pulled off the neck of all these companies. I mean, think of crypto that's been unbanked. Think of every industry's. It's been a very anti-business administration prior. But then on the other hand, you have the parts of the economy like the labor market, which have sort of just been. I mean, the labor market data would have been way more deteriorated if it was just private sector. And so you have this rolling over as government spending and government fiscally stimulated industries are slowing quite dramatically. And that's, like we said, the only driver of job growth has been government related stuff. And as that's kind of rolling over and slowing down, you're seeing that data really markedly weaken, whereas it's going to take some time for the private, manufacturing, et cetera, to kind of heat back up. And that's kind of what I think is this dichotomy. So I think there's an explanation for it, but the thing is like, everybody just wants to know, is the S&P 500 a buy or not? And it's like,
Yeah.
I think this dispersion is like, it's like so much more complex. And, if you're a stock picker looking at all these industries that just, have like a multi-year headwind turn into a tailwind and vice versa, like it's opportunity rich, but it's when the indices are sitting at 2021 peak valuation levels and there's all these kind of landmines to navigate as a new administration coming in, it's a little more murky.
I think the best framework is like we've kind of already said, but we've gone through this 2 or 3 years where we've just floated the economy through from fiscal expansion. And that just hasn't, it's been real, but it's also not been real. And now, if you just listen to Scott Bessent talk, he keeps saying this idea of like non-inflationary growth, which is productivity growth. And so they really want that. So I think they're willing to, crack some eggs on the process of going from where we've been the last few years, which is just this synthetic economy driven by government spending, to this fundamental increase in productivity and real non-inflationary growth. And yeah, I think that the framework is that they're willing to crack some eggs in that process, and you're seeing that. And that process is easier to be done with slightly lower bond yields, if it comes at the cost of slightly lower growth as well.
But sustainable growth and better growth, yeah, and more efficient allocation of capital. I mean, perception is a wild thing because I think one of my better attributes when it comes to investing in markets is the psychology component. And it's like reading the room. Where's positioning? Where's sentiment? How is that affecting like, your outlook and your trades? But it's funny to me because I was listening to a podcast this week, someone who I think is smart, but he was making a snide remark, talking about Trump and the administration's priorities. And he's like, oh, well, yeah, I guess, maybe if it is a priority for them, this particular topic, but we all know, who knows what their priorities are these days because there's so many of them. And I was just like, wait, you're like upset that the government is actually doing something for once? Like you're upset that Elon's hiring like the smartest, young computer engineers in the world that he would otherwise be paying tons of money at SpaceX and Tesla and all these like private companies to now work for the government and optimize. Like we just complained for 4 years about like excess spending and debt and all these things. And they're literally just going to town on the problems, hitting them right on the head, trying to fix Ukraine, Russia, trying to solve like, oil and like go to the Middle East. Like it's in all the headlines is this negative connotation, but there's so much more hollow than his previous administration because they're like just getting stuff done. And it's all of a sudden this bad thing. It's like, oh my God, they're doing too much. They're not focused. It's like, yeah, because they actually are doing something. I mean, this is incredible. Like how their pace, I mean, their deliberate approach and just surgical down the line. I mean, it's incredible. Like Bessent. I love Bessent. He seems just like such a good guy, and he doesn't give in to any, snide. Like it's impressive, and everybody's noticing. It's a crazy change in sentiment from. I mean, remember the hysteria in like October, and now what's going on? I mean,
Yeah.
it's tough to believe, honestly,
Mhm.
but all good
Yeah,
things, even if it doesn't mean the S&P 500 keeps going up and to the right on some fake liquidity boost.
for sure. I mean, and it's hard too. Like after a couple of years of such good returns and where valuations are at, that's asking for a lot, even in a full on, liquidity bonanza like we've had. So,
Well,
yeah,
yeah, two over 120% straight returns for Bitcoin, and then the two back-to-back strongest S&P cumulative years since 1928. It's like,
mhm.
I mean, come on.
Yeah, yeah. It's hard to ask for much more. I want to, on that point, talk a little bit about the MicroStrategy earnings that came out this week. It's funny, like Mike Ippolito just he messaged us in the chat, and he's just like, "Did you guys realize that like Saylor threw like basically half of his like $42 billion buy orders in a quarter? Like he bought like 22 billion in Bitcoin, and we didn't." You could either view that as a success or as a bearish situation. I mean, he threw half of that. Like that was like a 4-year vision, and he did it in a quarter, half of it. And we didn't break 110K on Bitcoin. I don't know. What do you think about that whole situation?
I think the error, I mean, go look at the drivers of this MSTR stock price, which is the harvesting volatility, aka getting retail to buy your leverage ETFs that create gamma in the stock, and you're able to sell overvalued shares and buy Bitcoin. Like it's just deflating. Like the hot air's coming out. Retail's gotten clobbered. They've gotten absolutely smoked. By the way, if look up the story I contributed to this week about the ETHU levered 2x ETH ETF, which is is the exact reason no one's talking about it anywhere, but is my short ETH thesis. Always got to throw the alpha at the end of these pods to see who's listening. But there's a reason that the crypto market on Sunday started dumping when CME futures opened, and that's because ETH was down so dramatically that the ETHU 2x futures ETF had to rebalance and absolutely liquidated like crazy. And that was no one's talking about it. And it was all retail driven speculation. Post election, the amount of CME open interest futures on ETH 3x'd, and Bitcoin was basically flat on a coins basis. And the prices for ETH did nothing, and Bitcoin's up and to the right. People are way over their skis. They still are. This problem hasn't been fixed in alts generally. So going to Bitcoin and MicroStrategy, these retailers who have been buying this are getting clobbered. MSTR, MSTU, MSTX, the levered ETFs are smoked. There's no more, like, you just need time to digest this. He front ran 20 billion. He was a third of all flows into Bitcoin last year, and most of that in Q4. And people think that this can just magically continue. This is like a pull forward of demand like you wouldn't believe. We're going to chop for another 6, maybe 9, maybe 12 months. When you combine that with the
What's the
Trump
premium
stuff.
at now? Like 1.6, I think, or something. So I
Yeah,
mean,
it's like 9, 10 month low or something.
yeah, there's not the ammunition that there was before.
Yeah, and like you said, it's like, I mean, we're at 100K, so like great. But it's like you have to, that thesis played out. Like now what's the next thing? And the next game is this chop and get everyone really flustered while we digest all this front ran demand before we can make the next leg up. Like that's just how assets trade. Like trees don't grow to the sky.
Exactly. Yeah. And then so, obviously the dangling fruit now is like, okay, the strategic Bitcoin reserve, David Sachs said we're going to evaluate it. And then there's the sovereign wealth fund thing, which I don't know, maybe we should talk about that because I think
I don't like it.
I'm a hater. I don't like,
Yeah.
I don't know, man. Like those wealth funds are for countries with surpluses where it's like, what else are we going to do with this money? All right, let's make some more money with it. It's not, okay, we're already in a huge deficit. Let's go into a bigger deficit to decide to turn the government into a hedge fund and then, give my tax money to the government to make a return on it. Like that's insane to me.
Yeah. Well, I guess the viewers who comment on my political takes will like this and show that I'm just evaluating everything, what I think is right and wrong based on merit and less emotion. But, I'm sitting here saying I think they're doing a fantastic job across the board. But I'm also saying I don't think stock prices are just going to go in a straight line up forever. And I think this strategic crypto reserve or whatever they called it to potentially include other assets outside of Bitcoin. I think the Bitcoin one should not happen. I think one without Bitcoin, like other assets, is completely lunacy. And this too, like for the reasons you outlined, like of course Trump, Bessent, and Sachs, who like are career lifelong investors, going to want to invest with unlimited money. But like, come on, like we don't need it. That's not the government's place. You're better off putting, the right processes and regulations in place for that to happen in the private sector. And when you unleash banks and financial institutions and deregulate the energy policies, like you're going to get the investment you're trying to get. But yeah, it shouldn't come from the government. I mean, that's just like, but so you call it a spade, but overall, I think, and it probably won't get through, it's just like, they have to keep pandering, right? The crypto voters and donors probably won them the election. So it's important. There's a lot of gamesmanship in this stuff. You have to remember. So yeah, that just keep all that stuff in mind as you evaluate these headlines, because a lot of time they're pretty hollow.
Well said. We'll clip that and show it off that Quinn is indeed objective. So well done on that.
Dude, I was crying at your tweets this week, man. You inspired me to be kind of like a little bit, do some shit posting. But when you said a couple more working groups, like your working group tweets, and then your Fentzar, you and George are gonna be the Fentzar.
Oh my god! Yeah, I know. I'm just farming yaps.
You had me cracking up, man. You had me cracking up.
I love that. I appreciate it. Yeah, I turned my anger and frustration about the Canadian situation into just shit posts, and it turned out really well for me.
Dude, everyone can just be aligned that like Trudeau sucks and like
that's a fact. Yeah. I can't wait until about one more month or so. So we'll see.
Yeah, but on the MicroStrategy stuff, it's like it's all the things you kind of look for like. I don't think it's gonna blow up like some people's hyperbolic things, but like he's not gonna buy this much Bitcoin going forward. And if he's not gonna be able to buy it, which I don't think he is because of the market dynamics, then Bitcoin's price isn't gonna, like, it's a bigger asset now. It takes more flows to move it. So presumably to make the same amount of price appreciation percentage terms, you need more dollars. And we're saying here that he probably gets less dollar purchases in 2025. So people just need to like zoom out and put on your like rational thinking hats and not your like, Doge to the moon hats.
Mm-hmm. Yeah,
put on your Oilers hat.
Put on an Oilers hat. Yeah, third in the league now. We've been running it up. We're killing it right now.
Yeah, put on your hotline hat.
Yeah. We'll leave it there before you get too carried away. Another great one. Obviously, the jobs reports tomorrow. We'll see what's going on there. But I think maybe we should
cover that quick. It's whatever we say is probably going to be completely like flipped on its head. But do you have strong views on it?
I think it'll be somewhat strong. I mean, initial claims are on the floor. Jolts looked like there's some, the front number came down in terms of job openings, but when you look into some of the more granular numbers, it's pretty decent. I don't know. I don't see any reason why there will be anything significantly down. But also, I don't see any reason for it to be significantly hot either. I think the era of the NFP being the most important metric is starting to wane. I think it's back in. Honestly, it's all Trump, really. Like it's the fiscal thing. Maybe you could say CPI, but I think overall, like the era of the NFP being everything right has waned for sure.
Yeah, we have honestly on both fronts, because like the Fed sitting here and they're like, we think we're close to neutral. We just cut 100. Like we're not going to like just floor it just to floor it with stocks at all-time highs. And then CPI is, I would say, if oil is going to keep tanking, I'm going to be constructive on soft to like inflation not being a problem.
Yeah.
And the jolts leading kind of wage inflation stuff is showing weakness, and China's still probably exporting deflation. And then on the labor front, so I kind of think inflation isn't a problem for right now. Like, and then labor front, I do think it will be, but labor front, yeah, I'm looking at the Bloom. It's 175K survey. It's right. It's kind of down the chute. Like it's not cold, not hot. So, but it's not going to really change too much. So, like you said, these moves that we need to be watching is like, I mean, if Elon's cutting like 1% of the government's workforce every week, like that's probably a more pertinent data point than like a sleepy, delayed labor market read that gets revised by 50%.
Yeah, I will say the one thing though is that there is the annual benchmark revisions coming tomorrow in this one, so that'll be interesting. Keep an eye out for that. But aside from that, I think if you're trying to keep it simple while you pay attention in the macro world right now, it's Scott Bessent and Trump, honestly, and Elon. Like,
it's tough to like. I feel like stocks are just kind of here and gonna tread water. It's hard to say like there's any crazy up, down, very big impetus reaction from tomorrow's data. It's like, unless there's a huge surprise, obviously, like, that's going to spook, but doesn't seem likely.
All right. Well, there's our view. We'll see how it goes.
Yeah, it'll be wrong. And then we'll do a little like post recap record or something. If we're like completely.
But sweet. All right. Well, have a good weekend and see y'all later.